I've seen a little bit of things go on. I've been around before. So, what I really want to talk to you today about is really the first step is, since most of the people here with the intention that this is going to be their first home so far, they haven't had an experience buying a home before, or trying to obtain a mortgage, I wanted to get you guys prepared so that you have a good understanding of what it really takes to make a good loan, and that's what we're going to go to first. So I'll just explain really briefly that, you know, a lot of people think, oh, you know, credit is all I need, or, you know, I have a job, I have lousy credit, but I have a lot of money, or I have a really good income. So, okay, I want you to think a loan as a table. Now, a table has to have how many legs? Four.
Some tables got 3 legs.
Some tables have 3 legs. Perfect. And I totally want you, right, and I love it. I love it. What's your name again?
Alex.
Alex, thank you so much. Alex is going to be my guinea pig for this whole thing. He's great. So I want you to kick one leg off. That's the appraisal. That's the collateral. So that last one in here, that collateral. Okay, so the rest of it is all you. And it's based on 3 things: credit, income, and assets. And if you kick one more leg off that table, you don't have a standing table. So you can't have a good loan without credit, income, and assets. If you're missing one of those, you don't get a loan. And the problem with most lenders is they don't check all 3. They do a credit check, and it's kind of like checking your pulse. They don't even read that credit report really well. They score that loan electronically for approval, and they just give you something without telling you what the rest of the concerns and the conditions that you're going to meet. So we'll talk about those. Co-borrowers. Now, a lot of people always talk about co-borrowers and go like, oh yeah, you know, well, I don't qualify for the loan, but what if I add someone else that's more qualifiable than me? Okay. So I want you to get one concept straight. There is no such thing as a co-borrower for mortgages. You are borrowers. Yeah, the word is co-borrow, but you're not signing for somebody else. You're not vouching for someone else. This is you on the mortgage.
Okay.
You are indebted. So there's no such thing as co-borrowers. You're both borrowers. And I want you to remember one rule. The best of both of you doesn't push you up, but the worst of both of you drags you down. So that if one person doesn't qualify on the loan, just because you add one better person, you're going to qualify? No. Because if this person doesn't qualify, they can't be on the loan at all. So, the best of you doesn't push the loan up, the worst of you drags the loan down. So just to reiterate, oh, well, my credit's not so great, but my wife is going to save me, or my parents are going to save me. Nope. This is a thing in which I want you to understand what is the best kind of rescue. I learned this rafting. I was a whitewater rafting guy. A self-rescue, one in which you are the most active participant in your own rescue. So this is what we're going to talk about today, is getting your own loan. Then we're going to talk about a little bit on the basics, in particular, of an FHA loan. It's put together by the Federal Housing Authority, or HUD, and they're the ones that produce this wonderful loan product that is more lenient in credit terms and asset terms, meaning money that you have to put down with your closing costs, in order for you to make it more affordable for most people to get into homes. So we'll just talk briefly about the FHA loan, and next time we'll do the conventional loan, and we'll do other topics as well. So, and then we'll have a small question and answer period. So, first we're going to talk about credit. Now, the misconception about scores. Everybody's always like, well, I got this score, can I qualify? Or what's the minimum score to qualify? Now, I remember as a kid, again, I was Argentinian, so Argentinians, we don't play basketball. So, you know, my parents never showed me how to play basketball. I was in elementary school, you know, and when I was back in elementary school, they graded you even in gym.
Man.
So I remember, you know, rifling through a whole bunch of my old kid stuff that my mom had and some storage unit, and I came across this sheet. It was like one of those little awards that they give you. And it was an award from gym, and it said the minimum competency ball skills. You know, David has achieved the minimum competency in ball skills. Well, this doesn't sound good. So I don't want you to think about minimum credit scores, because minimum credit scores come with other things attached to them. So it's not just about credit scores. It really is much more about what really counts and makes the difference is much more than credit scores. It's how you treat your credit as a whole and how much credit you have. So it's made up of credit score. That's one important thing. Credit depth is very important. Anybody know what credit depth is? Cool.
How long you have a credit for, an account open, active?
Right, how many accounts you have and how long you've had them open for. So, now, let's say I have Alex over here and he's got 2 credit cards and a car loan. And then, I'm sorry, what was your name?
Carolina.
Carolina. Carolina only
With
has...
an R, I'm sorry, Carolina.
Carolina.
Caterina.
Caterina.
Caterina, oh, sorry.
I can
Caterina.
roll the R.
Oh, sorry, no, roll it. Caterina.
Or cat.
Okay, Caterina, let's say only has 1 credit card.
Oh, wait.
So who's got more credit depth?
But we don't know how long they've had it.
Right, but let's say you've had your cars in car for a few years, and you've just had your credit card for like 4. The credit depth, she has more credit. He has more credit. It's been there for a longer amount of time. He has more credit depth. The more credit depth you have, the more better your score is going to be, and the more impervious to your score going down if something small happens. Because you have a lot of buffer. So if you have like 12 cards, a couple car loans and a mortgage, and a student loan still remaining, a few of them, then you know you have a pretty bulletproof score. So if a collection happens by accident or something like that, my credit score will take a little dump, but it won't tank as much as, you know, poor Katerina with only 1 credit card, because you only got 1 credit card to show for it. So credit depth is very important, and then credit history. What do I mean about credit history? Not just the amount of time that you had that credit card, but how you pay it and how you treat it. And that is even going to be more important in the future, because now that they've gone to what's called trended credit reports. So before, they just looked at how much you had on a balance versus your limit. And obviously, the closer to your limit on the balance you are, the less ability to use that credit, because I'm credit crunched, gives you a lower credit score, because you've taken all your credit and you sucked it and you used it. Now you have no credit. So now when you call up another credit card company and say, I need another credit card, they look at your credit score and your credit tanked because your balances are so high to your limit, they don't want to extend any more credit to you. So, credit history, the way you pay your accounts and paying them on time is the most important thing. This is what I mean about credit history. So now, like I said, with trended credit, they're not just going to show that you pay it on time and what your balance is to your limit, but they're also going to show how you pay. Are you just the person that pays the minimum every time? Or are you the person that pays more down on your? Are you miss a payment and then have to double up? What is wrong with you? So they're going to be looking seriously at trended credit reports a lot more in the next few years. So what seemed even simpler for more people to get financed after this downturn in the market may have a little bit of backlash in the future. So credit availability, that's what I was talking about. Making sure that your balances are low compared to your limits. It's a very big important thing. Okay. This is the key. And I want you to write this down on your credit first-time home buyer checklist. It's the rule of 3. 3 open, active, paid on time. 3 open, active, paid on time. 3 or more, obviously. Now, what reports on your credit report? Credit cards, student loans, installment loans, like, you know, those Aaron rent to own kind of things, car loans, mortgages, equity lines with your bank, those kinds of things. What doesn't report? Rent, utilities, phone bill, none of that reports on your credit report. So, how many of you do not have 3 credit cards or 3 open trade lines that are active on a credit report? How many? Raise your hand.
Don't have or have?
Don't. So everybody has 3 open trade lines? Great. Fantastic. So, 3 open trade lines. That means they have to be open. That means if you close them, say, hey, I don't want this credit card anymore, your score drops. It's like saying, hey bank, I know you gave me this credit card, I just can't handle it, close it for me. It's also worse if they close it for you, but it means you haven't been paying, but you want to keep it open. So that means a car, let's say I pay off a car and I will buy a new car and get into a new loan. Good thing, I paid off my car, great for me, I don't have another payment next month, but guess what? I don't have another credit line reporting. I just dropped my credit line. my best reporting credit line, because my balance is here, my limit when I took out the loan was there, it's huge, and I've been paying so many payments on time, so I don't roll into a new loan, I lose that open status. Please replace that with a credit card or another. I'm not saying go out and buy another car. I'm not saying go refinance and take out more money. Open up another credit card to replace that car loan that goes away. I'm not saying you have to like put money on that card and pay it and use it, but active. It means that the cards have to be used. They don't have to be used every month. You don't have to keep a balance on them. You don't have to make payments every month. You want to pay it off? Great. You can buy a pack of gum every 3 months. As long as it's active, means you used it once every 12 months. You should use it once every 3 or 4 just to flex your muscle. Just like gym. And then paid on time. I forgot to put paid on time, so put paid on time somewhere in here.
Yeah.
Paid on time. The most important thing. Now, when you pay a credit card late on the statement, it's not 30 days late. That's just late. So you got to miss a whole month to be 30 days late. You got to miss the next month's statement to miss that payment. Same thing with a car. So as long as you pay within your 30 days and you don't accumulate any late payments, you're going to have a bulletproof score, and that's what we want to see. Because we don't want to see 640s, I want to see 720s. 640, you become a mortgage broker's victim. 620, 600, you become the mortgage broker's victim. I give you what I got, and you got to take it. And most mortgage brokers are not competitive and wonderful, meaning that the worse your credit is, the more they take advantage of it. And that's just the facts, unfortunately. Okay, now, the most important thing is mortgages are the ones that count. These are the types of trade lines: car loans, personal student loans, credit cards.